Peace in the Middle East is a victory for humanity. But why does it feel like the most painful trap for your wallet right now? While you're panicking as gold and silver prices plummet, the financial giants are smiling behind closed doors. Is this the end of a cycle, or just a perfectly timed liquidity trap designed to shake you out? Stick around, because we are about to decode the dark secrets of the peace trap right now. To understand why our wallets are being threatened, we first need to look at what is truly driving the market. It's not the missiles, it's not the diplomacy, it's psychology. Have you ever noticed that the market often does the exact opposite of what the headlines suggest? This is the classic sell the news trap. For weeks, gold and silver prices were driven to record highs by one thing: fear. Fear of a widening war, fear of supply chain collapses, and the desperate need for a safe haven. But the moment a headline mentions peace negotiations or signs of progress, that fear evaporates. What follows is what experts call a relief rally in risky assets like stocks. But for gold, it's a sharp, painful correction. Think of it like a pressure cooker. The geopolitical tension built up the steam. The peace talk news? That's just someone pulling the valve. The price doesn't drop because gold is suddenly worthless. It drops because the risk premium, that extra price people paid out of pure terror, is being sucked out of the market. Now look at the screen. When the charts turn red, what is the average retail investor doing? They are staring at their phones, watching their profits vanish in minutes, and their heart rate starts to climb. This is where crowd psychology takes over. There is a biological reason for this. When we see a sea of red, our brain's amygdala triggers a fight or flight response. Logic goes out the window. You don't think about long-term cycles or debt ratios. You only think, I need to get out before I lose everything. This is instinctive selling. But here's the irrational part. The fundamentals of the global economy haven't changed. Central banks are still printing money. Global debt is still at record levels. The industrial demand for silver and AI and green energy hasn't moved an inch. Yet the crowd sells anyway. They sell because they see others selling. It's a domino effect. In the world of professional trading, your panic is their liquidity. Every time a retail investor clicks sell in a moment of blind fear, there's an institutional buyer on the other end, calmly catching that falling knife at a discount. They know that peace in a headline is often just a temporary pause in a much larger, more volatile story. The logic of supply and demand here is being distorted by the illusion of certainty. The crowd believes that peace means stability, but in a world of complex debt and shifting alliances, stability is often just a transition period between one crisis and the next. By selling now based on a single headline, you're effectively paying a tax on impatience. You're exiting a hard asset exactly when the noise is loudest. But the real question we have to ask is, if everyone is selling, who is actually buying? Who is the invisible hand that is absorbing all this panic-selling volume without breaking a sweat? The answer reveals the true divide between those who lose money in the news cycle and those who build wealth through it. Because while the headlines focus on the olive branch of peace, the actual data, the cold, hard numbers, shows a very different movement happening behind the scenes. But wait, if you think this is just about small investors getting scared, you're missing the biggest piece of the puzzle. Because there are players in this market who don't care about headlines. They don't care about peace talks. In fact, they've been waiting for this exact moment to strike. Let's dive into the dark pools of the financial giants to see what they are actually doing while you're staring at the red candles. But hold on for just a second. If gold is truly over and the crisis is supposedly fading, why are the world's most powerful financial institutions acting like they're preparing for a fire sale? Why are central banks hoarding gold at the most aggressive rate in modern history right at this very moment? This is the divide between smart money and dumb money. While retail investors are glued to news tickers, reacting to every headline about peace talks, the giants are looking at the 10-year horizon. They're not playing the news, they're playing the cycle. Take a look at the data from the World Gold Council. In the midst of recent price volatility, nations like China, Poland, and India haven't just been holding, they've been accumulating. These aren't emotional traders, these are institutions with the most sophisticated economic models on the planet. They see through the peace trap. They know that geopolitical tension is just one pillar supporting gold. The other, much heavier pillars are global debt, currency debasement, and the fracturing of the US dollar's hegemony. This brings us to a critical concept you need to understand: absorption. In the trading world, when you see a massive wave of selling, the kind driven by the dumb money panic we just talked about, and yet the price doesn't collapse to zero, it's because someone is sitting there, quietly absorbing every single ounce. They are using your fear as a liquidity window to fill their massive iceberg orders without spiking the price. They want you to be scared. They need you to sell, because they cannot buy thousands of tons of gold if everyone is holding on to it. They are effectively voondopping their positions while the headlines keep you distracted. While you see red candles and a relief rally in stocks, they see a discounted entry. Think about it. Why did the National Bank of Poland increase its reserves so drastically?
Why is the East moving away from paper assets and back into hard assets? It's because they recognize that peace in a press release doesn't fix a $34 trillion debt. It doesn't fix inflation that refuses to stay down. When the smart money buys, they don't care if the price drops another 2% tomorrow because of a ceasefire. They are focused on the chaos tax, the reality that in a deglobalizing world, tangible assets are the only true final settlers of debt. So, ask yourself, who do you want to follow? The panicked crowd selling their silver and gold at the first sign of a handshake in a hotel lobby? Or the central banks who are quietly building a fortress of bullion while the world is distracted by the noise? But don't be fooled into thinking this is just a simple buy and hold story. There's a reason this trap is so effective, and it's buried deep in our own history. Because what happens after these peace negotiations fail, or even when they succeed, is a pattern that has repeated for over a century. If you think the current price drop is scary, you haven't seen what happens when the Bei Wa Bing trap finally snaps shut. To see where this is going, we have to look at the one thing the headlines always ignore: the ghost of markets past. History has a funny way of repeating itself, especially when most people are too distracted by the present to look back. If you think the current price dip is a sign of a permanent trend, you need to see the ghost of markets past. Let's look at the data. Go back to early 2024. Remember the headlines about the ceasefire negotiations in Cairo and Doha. Every time a news notification popped up saying deal is close, gold and silver prices took a dive. The peace trap was set. Retail investors sold their positions, convinced that the war premium was gone for good. But what actually happened? The negotiations stalled. Tensions flared even higher, and gold didn't just recover, it exploded to new all-time highs. The market follows a predictable pattern: rumor of peace, reality of pivot. But it goes deeper than just the last 2 years. Look at the 1970s, the golden era for precious metals. During the height of the Cold War and Middle Eastern oil embargoes, the market went through multiple relief rallies whenever a diplomatic handshake was photographed. People thought the crisis was over, but they forgot the underlying cause: inflation. Even when the guns went silent for a moment, the debasement of the dollar continued. The result? Gold went from $35 to $850 an ounce over that decade, despite dozens of peace talks along the way. What we are seeing today is a mirror image of these historical cycles. Why? Because the peace trap relies on a fundamental misunderstanding. People think gold is only about war. It's not. Gold is about risk. And right now, the risks are piling up like never before. If these negotiations succeed, you might see a temporary calm, but history proves that in a world of record-breaking debt, peace is often the most expensive time to buy insurance. When the market stops worrying about bombs, it starts worrying about the interest rates and the supply chains. Look at the 2022 escalation in Ukraine. When the first round of talks happened on the Belarusian border, the market staged a massive relief rally. Risk sentiment soared. Gold fell. But those who sold then missed the 20% surge that followed just months later. Why? Because the solution was a mirage. The underlying geopolitical fracture had already happened, and there was no going back. The lesson from history is clear. The peace trap is designed to shake out the weak hands before the real move happens. Market makers use these windows of optimism to reset. They clear out the over-leveraged long positions, the people who bought at the top out of fear, and they prepare for the next leg up. Whether it's 1974, 2024, or today in 2026, the mechanics remain the same. The headlines change names and locations, but the math of the hard asset remains undefeated. So, if you're staring at the red candles today, ask yourself, is this the first time a ceasefire headline has pushed prices down? No. Is it the first time it has turned out to be a temporary dip in a long-term bull market? History says absolutely not. But knowing history is only half the battle. You have to know how to move when the trap snaps shut. Because while history tells us what happened, it doesn't give you a strategy for tomorrow morning. To survive this, you need more than a history book. You need a cold-blooded plan. You need to know exactly how to play the counter-trend before the rest of the world realizes they've been played.
Let's move from the history books to the battlefield of your own portfolio. How do you turn this trap into your greatest advantage? Knowing history is only half the battle. You have to know how to move when the trap snaps shut. Because while history tells us what happened, it doesn't give you a strategy for tomorrow morning. To turn this trap into your greatest advantage, you must shift from being a news-reacting victim to a data-driven investor. The secret to contrarian investing isn't just doing the opposite of everyone else, it's doing the opposite for the right reasons. While the crowd is obsessing over the latest ceasefire tweet, you need to be looking at the cold, hard mechanics of the economy. First, stop looking at the war headlines and start looking at the CPI and the Fed. Ask yourself, does a temporary truce in the Middle East fix the trillion-dollar deficit? Does it stop the massive AI-driven demand for copper and silver? Does it lower the core inflation that has been eating away at the dollar's purchasing power? The answer is a resounding no. In fact, if peace causes oil prices to drop, it might actually give the Federal Reserve an excuse to cut interest rates. And what happens to gold when interest rates drop? It traditionally skyrockets. This is the ultimate irony. The very peace that scares people into selling gold might be the exact catalyst that triggers its next massive bull run. So how do you manage your risk right now? Step 1. Stop all-in thinking. High volatility isn't a signal to gamble, it's a signal to scale. Instead of trying to catch the exact bottom of this peace trap, use a dollar-cost averaging approach. By slowly accumulating as the price dips, you are essentially letting the smart money do the heavy lifting for you. You are absorbing the liquidity along with the giants. Step 2. Diversify your hard assets. Don't just stare at gold. Look at silver and industrial commodities. If a relief rally kicks in because of peace, industrial activity often picks up. This means the demand for silver in solar panels and electronics will likely surge. You're not just hedging against war, you're betting on the inevitable rebound of global production. Step 3. Set your emotion circuit breakers. Before you even open your trading app, decide on your exit and entry points based on price, not news. If you see a 5% drop, is that a reason to panic, or is that the discount you've been waiting for? By setting these rules in advance, you kill the amygdala response we talked about earlier. You become the predator, not the prey. Remember, the market is a machine designed to transfer wealth from the impatient to the patient. If you can stay calm while the headlines are screaming, you've already won 90% of the game. You are no longer just a spectator, you are a player who understands the board. But as we wrap this up, we have to look at the bigger picture, because this isn't just about 1 week of trading or one peace deal. This is about a fundamental shift in how the world values real things versus paper promises. The peace trap is just a small ripple in a much larger tide. As we move forward, the question isn't whether the price will go up or down tomorrow. The question is, where will you be standing when the man hoi finally clears and the true value of hard assets is revealed? Let's bring this all together and see what the next move looks like for those of us who refuse to be tricked. As we've seen today, peace in the Middle East is a win for humanity, but in the brutal world of finance, it is often a smokescreen. It is a calculated mechanism used to transfer wealth from the impatient who react to headlines to the visionaries who observe the underlying data. The peace trap is designed to make you blink, to make you sell your hard-earned assets just as the smart money is moving in to absorb them. But you are no longer part of that panicked crowd. You now know that while the news cycle is fast, the economic cycle is deep. Do not let a single press release or a temporary relief rally dictate your financial future. The fundamentals, the debt, the inflation, and the industrial demand haven't changed. Only the noise has. So, the choice is yours. Will you run with the crowd at the first sign of a handshake in a hotel lobby? Or will you stay calm and follow the silent trail of the central banks? If you believe this dip is nothing more than a temporary pause in a much larger bull run, drop the word gold in the comments below. Let's see how many of us are looking through the noise. And if you found this analysis valuable, make sure to hit that subscribe button and turn on notifications. The peace trap is just the beginning. You don't want to miss the underground shifts we'll be uncovering next. Thank you for watching, stay sharp, and I'll see you in the next deep dive.